All right, good morning or good afternoon, depending on where you are. I hope everyone is having some ability to stay out of the heat that it seems to have enveloped the entire country. But thank you for taking some time out of your day to join us for Multnomah Group's July webinar. Today's topic, we're going to focus on a fiduciary training program and just talking about the roles and responsibilities that hopefully, I'm sure a lot of you on the call serve in the role as a fiduciary for your plans. So just want to do a very high level review of what it means to be a fiduciary. Before I get started though, just for any of you who are not familiar with Multnomah Group, we are a full service investment and retirement plan consulting firm. We work across the nation representing 162 clients who have 264 plans, and we advise on over $27 billion in assets. We are an employee-owned firm. If you've been following the investment advisor industry, you've seen an awful lot of consolidation going on, and we are pleased to not be a part of that. So we remain employee-owned, which I think also allows us to remain very conflict-free in the services that we provide to our clients. My name is Greg Johnson. I'm a senior consultant at Multnomah Group. I'm also the director of our ERISA Technical Services Committee that focuses on litigation, legislation, is also responsible for building out a lot of the fiduciary education program that you see here. I am joined today by Candace Finn, who is just about to start her third year of law school at Lewis & Clark, and also is a retirement plan analyst here at Multnomah Group. So for today's program, we're going to talk a little bit about the rules and regulations that govern retirement plans. And a lot of these rules and regulations tie into what your role is as a fiduciary and dictate the things that you can and can't do. We're going to talk about what it means to be an ERISA fiduciary and the responsibilities that go along with that. And then at the very end, we're going to talk a little bit about some of the plan governance documents that support that we see with a typical committee to support you in meeting your fiduciary responsibilities. So what we're doing today is level 1, exploring fiduciary responsibilities. We have built out a very robust fiduciary education program at Multnomah Group. Level 2 does sort of a deep dive on a lot of the topics we're covering today. So it focuses on fiduciary governance, service providers and fees, employee engagement services. We have a section on plan operations and a separate presentation on investments. And then when we get into level 3, each one of those 5 topics, we drill down on information a little further. So if there's ever any information that you're wondering about, we could just use a little bit of a primer on sort of what this topic is. I would encourage you to look at our website or reach out to your consultant or even reach out directly to me. Because of any of the topics that we cover today, if you're thinking, boy, I'd like to understand that a little bit better, we likely do have materials that will provide a deeper dive. So let's go ahead and start by talking about when you think about your retirement plan, what are the governing rules and regulations? Where do you look to for information on how you're supposed to operate your plan? So for that, I'm going to turn it over to Candace to talk a little bit about the primary rules that govern your retirement plan.
Thanks, Greg. So there's 2 main governing bodies here that regarding governing your retirement plan. So the first is ERISA, which is the Employment Retirement Income Securities Act of 1974, and the IRC, the Internal Revenue Code that's governed by the IRS. So what is ERISA? ERISA is the primary law governing most plans. So the Department of Labor, the DOL, is the agency that's primarily charged with administering ERISA and establish the Employee Benefit Security Administration, or the EBSA, which assists in enforcing the fiduciary reporting and disclosure provisions of ERISA. So what does ERISA do? It requires plans to provide participants with information about the plan. It sets minimum standards for participation, vesting, benefit accrual, funding. It requires accountability of plan fiduciaries, and it gives participants the right to sue for benefits of breach of fiduciary duty, which Greg will talk a little bit about later. And then it guarantees payment of certain benefits if a defined plan is terminated. The IRS also oversees many plan retirement rules and regulations, the majority of which the IRS oversees is really more participant related for personal income tax. And so a lot of that's related back to the actual individual participant. So what is a fiduciary duty? What is a fiduciary? It's a person who exercises discretion over the management of plan or plan assets, which is usually your plan sponsor or a committee, someone who renders investment advice to a plan or a plan participant for compensation, which is kind of like an investment advisor or somebody who offers participant investment advice. And then lastly, someone who has discretionary authority in the administration of the plan, like your record keeper or a third-party provider. All plans have at least one fiduciary duty, and they must be named to the plan document. So that named fiduciary duty can delegate some of those responsibilities and some of that authority to a plan administrator, to service plan providers that agree to exercise that discretion, as mentioned in the first bullet, when they're providing those services. So, but one thing to remember, of course, is that named fiduciary remains responsible to be prudently select and monitor the plan service provider. So just because you delegate that authority away, you still have to appropriately, make sure that you monitor those fiduciaries where you hire or fire them. I'll pass it on to Greg to talk a little bit more about, difference between fiduciary decisions and settler decisions.
All right, thank you. Yeah, and when you think about who the fiduciary is, sometimes I've had clients, typically if you have a board or the governing body for your organization, often is the named fiduciary. Now, they very quickly delegate a lot of the responsibilities for the day-to-day administration of the plan to a committee or maybe certain individuals within the employer. But they do remain, as Candace said, they do remain a fiduciary under the plan. So if a board delegates authority, they should still receive at a minimum probably an annual report from the committee or whoever they delegated that responsibility to on any substantive decisions that were made relative to the plan. And speaking of decisions made for the plan, one of the first things that I think a committee or a fiduciary needs to really understand is the difference between what are called settler decisions, which I consider sort of employer decisions, and fiduciary decisions. And settler decisions, you can see here things like the decision to even start the plan or terminate the plan. Probably the most substantive decision that the settler makes or the employer makes is relative to the contribution levels that are in the plan. Fiduciary decisions, so the committee, what your fiduciary committee is making decisions on, are really related to sort of carrying out and executing the administration of the plan. So your fiduciary role involves things like deciding what investments to include within the plan. Candace talked about hiring third-party service providers. Those are fiduciary decisions. And I think the important distinction here is, the line between a settler decision and a fiduciary decision is often blurred. And there's a very good reason for that. If you have an investment committee, it is very common that you probably have members of your investment committee who in their day-to-day job have responsibility for making settler type decisions. But when they come into the room to be part of your fiduciary investment committee, they really need to remember to remove that settler hat and put on their fiduciary hat. And I think the best example that I can think of is, when COVID hit, there were a lot of our fiduciary committees having discussions about whether or not to change the funding rate to their retirement plan. And in reality, that's not where those conversations should be taking place. That's really an employer decision. Really, as a fiduciary, and it's in our slides coming up, but really every decision must be made in the best interest of the participants and their beneficiaries. And obviously a decision to reduce the contribution rate is not in the best interest of participants, right? So that is clearly a settler decision. But again, important as you think about your committee to understand when you may be drifting into settler type decisions. And oftentimes we'd like to pull the committee back and say, hey, let's just stay in our lane here and make only fiduciary decisions. So as far as the responsibilities, when you do think about what your role is as a fiduciary, this is straight from ERISA. So I'm going to go ahead and read them because these are the rules. Number one is acting solely in the interest of plan participants and beneficiaries with the exclusive purpose of providing benefits to them. And I do think this is one of the most important aspects. You always need to remember that you cannot allow outside influences or employer type decisions. If you think a decision is going to negatively impact you as an employer somehow, you need to remove that from your decision-making process. Carrying out your duties prudently, and this one's important, using the same level of care, diligence, prudence, and skill as someone familiar with such matters. So this is a little higher than just being prudent in your decision-making. It's considered the prudent expert roles, or prudent expert rule. So the committee members should have some degree of understanding or expertise relative to the items that they're governing. Obviously, you have to follow your plan documents unless they're inconsistent with ERISA. One of your roles is to diversify your plan investments, and the other is to pay only reasonable plan expenses. So as a fiduciary, you do want to make sure that at least annually you are reviewing the fees relative to what other providers may be providing. You see at the bottom of these responsibilities, the DOL says that the most important is the prudent process, and the prudent process that you follow permeates all 5 of these responsibilities. So it's really critical that you, as you make decisions, that you have a process in place. So let's take a look at sort of what that is. You know, when you're thinking about your committee and you're going to be making decisions, probably you want to start by gathering all the information. Whether that's provided by an investment advisor such as us, or whether you're collecting it individually. You analyze the information, you get together with your committee or any decision makers, and you make the decision. And perhaps the most important part of the prudent process is that you document the process or document the decision. And you'll see later, you don't always have to make the right decision, but as long as you can show that you followed an organized method of arriving at that decision, you will be protected. Now, there are certain things that you're not allowed to do as a fiduciary, and I'll let Candace talk about some of the prohibited transactions.
Thanks, Greg. Yeah, so prohibited transactions. So these couple of bullet points is kind of the areas where the DOL will typically get involved should you be doing some of these things. So between fiduciaries and other parties in interest, sales and exchange or lease between the plan and that party of interest, loans, furnishing of goods and services or facilities between the plan and the party in interest. And then of course, fiduciaries are also prohibited from using the plan assets in their own interest, acting on both sides of the transaction with the plan, and receiving money or other considerations for their personal account. So you don't want to be, going between your personal account and the plan or any monies in that way. Can really kind of get you in hot water here. Greg, what are some examples of these prohibited transactions that you could typically see or that might, land some plans in hot water?
Yeah, I think a lot of times the enforcement for prohibited transactions probably comes from the Department of Labor. So, if there's some plan administrative items or things like that, that's where the penalties and things arise. This first one, sale, exchange, or lease between the plan and a party in interest. I did see a recent case filed by the Department of Labor, actually against a law firm. The principal at the law firm was starting a new investment company or a new investment, and actually appropriated assets from the defined contribution plan and used them as sort of seed money for the new company that they were starting. That's clearly not allowed. That's being done in the principal's best interest, and that individual is certainly in hot water. Probably the most common type of prohibited transaction that I see is failure to remit contributions to a plan. This happens for a variety of reasons. Sometimes it's just an administrative error, and the money eventually gets into the plan. Typically, that requires looking at lost earnings to make sure everyone's whole. But sometimes it's done, for financial reasons. I probably see it most often. You maybe see a small employer that doesn't remit the contributions and actually uses them as operating capital for a short period of time. And the DOL, the second bullet here, talking about loans between the plan and party in interest, the DOL considers that a loan. Now, that's certainly not your traditional type of loan that you think of, right? I mean, normally you think, when you see that and think of loans between the plan and a party in interest, you think of some sort of formal agreement where someone is signing a document, getting some money and paying some interest back. But in reality, if you fail to remit contributions and then use them for your company, that is deemed a loan, and that is absolutely a prohibited transaction. Those are just 2 examples that I can think of. But let's talk about, let's turn back over to Candace and talk about some of the exceptions that are available. So some of the things, because if you see that in particular, the loan item, when you see that on loans, you're like, well, wait a minute, our plan offers loans. How can that be? So Candace, you want to talk about the exceptions?
Yeah, thanks, Greg. So there's 2 statutory exceptions that allow plans to hire and compensate third-party providers to support their administration of the plan and to allow loans from the plan balances to participants. Unlike the previous description of use of funds for corporate business, participant loans are initiated by the participant, and that interest is then charged back to the participant's account. So it's just within the participant's account, not within the business. So Both are used by most plans. Hiring third-party providers usually includes record keepers, auditors, attorneys, or investment advisors. And this can also include participant education services and additional services provided by a record keeper like managed accounts or transaction fees. So if you're paying expenses from the plan, it's important to remember that the distinction between settler and fiduciary decisions that Greg had mentioned earlier when you're implementing those decisions. Now I'll turn it over to Greg to look at some of the litigation related to those prohibited transactions and breach of fiduciary duties.
Yeah, thanks, Candace. I might just highlight the expenses related to settler decisions, that they cannot be paid for the plan. And this is sort of an area that I think as a fiduciary, you should just sort of keep an eye on. Now, for the most part, if you're paying plan expenses out of the company operating budget, there really isn't an issue. I mean, you can pay for anything you want, really. This comes up when you start using plan assets. So if you have like a revenue credit account or a revenue expense account where additional money is being used to pay for some of these third-party providers through the plan, that's when you really want to keep an eye on, hey, am I paying legitimate plan expenses that are based on the fiduciary decisions, or am I paying settler functions? So just sort of a practice point there to keep in mind. So one of the things that we talked about, when you think about your role as a fiduciary, one of the main things you want to do is avoid litigation, right? So I thought we'd talk a couple slides here about sort of what we're seeing relative to litigation. I mentioned earlier, you typically see lawsuits brought by either the DOL or by individual participants. A lot of the ERISA fee litigation that we're seeing right now is being brought, they're formed as class action suits. What's happening is plaintiff's counsel is identifying a small group of employees and having them sign on as the plaintiffs for the case, and then they file for a class action status, and then they bring their ERISA fee litigation lawsuit. Typically, the allegations that we see are, and again, remember, these are allegations. So these are the things that the plaintiffs are saying are happening. They're not necessarily they haven't necessarily been decided on, but these are 5 of the most common ones. Failure to offer the lowest share class investment. Investment companies offer different share classes, oftentimes for what is essentially the exact same mutual fund. And if it's identified that they're using a higher expense share class and there was a lower one available, that's one of the allegations. Too many investment options. This one has not really gotten a ton of traction. There are plans out there, though, that you see offering 100, 200 different investment options. And those are the ones that you're typically going to see targeted. One thing I would say relative to the litigation, though, there was a Supreme Court decision that for the Northwestern case that put it back down to the lower court. Northwestern was offering about 200 investment options. And the original decision sort of said, hey, you've got some low cost, the type of investments that plaintiffs are talking about are available in the plan. So even though you have 200 investments, the investments that the plaintiffs are saying they want, they're actually in the plan. So the Seventh Circuit actually found against the plaintiffs, the Supreme Court put it back down. And the important thing about that case is that it does seem to suggest that if you have a whole bunch of investment options in your plan, you do have a responsibility to monitor every single one of them. So, the lower court sort of said, hey, you've got some good investments in here. Maybe there's some bad ones as well, but you've got the good stuff, and that's really okay. And it does appear what the Supreme Court is saying is, if you have 80 investments that you're offering to your participants, you need to monitor all 80 of them. So I would think even the best investment committee that maybe has everything buttoned up and they're doing a great job monitoring everything in their plan, if they're offering 80 funds, my guess is that committee would probably make a decision to reduce the number of funds, because it is quite a bit of work to monitor that large of an investment menu. So again, I don't see that particular one getting a lot of traction with judicial decisions, but I do think some of the decisions are going to impact the number of investment options that are available. Failure to monitor record-keeping fees. I think every plan at a minimum annually should look at all the fees being charged to anyone providing services to the plan and benchmark them and make sure that they are reasonable. Utilizing multiple record keepers. This is more common in the nonprofit and the college and university space, where you see maybe multiple companies offering retirement plan options to their providers. The thought is that if you have two companies servicing your plan, it would be less expensive to just have one company. So we do see that one. And then use of active managed funds rather than indexed options. I do not think this one will ever get much traction because I don't even think the investment world is in complete agreement as to whether or not active investment options are superior to indexed options. But again, we do see this as one of the things that comes up. The last point here, though, and I mentioned it earlier when I was talking about prudent process, courts will not review your fiduciary decisions in hindsight. So like I said earlier, they're not going to say, hey, 10 years ago, you added this fund, and here's another fund that looks like it performed a lot better. You really should have used this fund. That's not the way they're going to review what happened. What they're going to do is look at the process that you used. And if you followed a prudent process in making the decision, maybe it turned out not to be the best decision of all the decisions that were, or all the options available. But as long as you followed a prudent process in making that decision, you should be okay. As far as the litigation settlements, so, only a few of these things have actually gone to trial. So a lot of what we're learning from the litigation is not necessarily from decisions that are coming from judges or juries, but it's from these settlements. Now, there's always a monetary component of these settlements, and these can range, I would say, anywhere from, on the lower end, probably $3 million. On the higher end, I think we've seen $30 and $40 million settlements. So certainly there's a monetary component that's of concern if your plan gets sued or involved in litigation. I think what's more telling, though, in these plans that have chosen to settle is some of the things that are being decided in addition to the monetary component. So one of them is mandatory annual training for the plan fiduciaries related to their ERISA responsibilities. For those of you on the meeting today, I think you're checking that box right now. Pricing record-keeping fees at a per participant rather than a percentage of assets basis. And this is definitely a trend that we've seen over the last 5 to 10 years throughout the retirement industry. I would say 10 years ago, most retirement plans were based on a percentage of assets. So the amount of money that the record keeper would sort of fluctuate with as the market was changing. We're getting more, almost all plans now are being priced at more of a per participant price. So you see a price of like $50 per participant. Maintaining the lowest cost share class for each investment offered. High use of an independent investment consultant. Some of the settlements require a full-blown RFP be conducted within the next 3 years. One of the newer ones that we're seeing pop up is restricting plan sponsors from using plan data to sell non-planned products. And then finally, in the event that you do have frozen investment options, there's a requirement that the plan sponsor inform participants that, hey, you're sort of locked into these investments, only you can move them. If you want, you have the opportunity to move into what we have as the monitored investment options as well. So I think these settlements really sort of point to some of the best practices that we're seeing in the industry. Now I want to turn it over to Candace to talk a little bit about, so your role as a fiduciary, you are potentially subject to personal liability. And I'll let Candace describe that a little more.
Thanks, Greg. So, as Greg said, having discussed who is a fiduciary, the role of a fiduciary, and, in a committee and some of the situations that can potentially cause problem. Now we'll focus on, of course, if you are a fiduciary, you as a fiduciary duty. So one of the things, of course, is that does make you face personal liability under ERISA for a breach of fiduciary duty. Greg highlighted some of the early examples of bad behavior that might trigger some administrative or legal enforcement. But some of those penalties could potentially include restore losses incurred by the plan, monetary penalty and taxes, criminal prosecution under federal law. And these cases can usually be brought by an individual plaintiff or a class if the class is able to get certified, or as the Department of Labor. So the Department of Labor, of course, recently, I think they even posted a news outlet recently about a recent settlement, as Greg was just talking about settlements, were a case that they had brought in the Southern District of New York. So something to keep in mind there. So, of course, you do have personal liability, but one of the great things is you can limit that personal liability with insurance and bonding. And so first is the fidelity bond, which really is more protection for the plan. So that is required by all benefit plans covered under ERISA. And the insurance helps protect the plan and participants from losses resulting from fraud or dishonesty. So some of those losses, of course, listed below: theft, forgery, the really nitty-gritty stuff that isn't great. The fiduciary liability insurance, so that's the one that helps protect the plan fiduciary from claims of breach of fiduciary duty. So that's the one that's a little bit maybe more relevant to you if you are a plan fiduciary. One of the things would be good to review your coverage if you haven't done that in a long time, to make sure that you feel comfortable with the amount of fiduciary coverage that you have for yourself. Greg, I know you've been kind of looking at some of these questionnaires that are required in order for the application for fiduciary insurance. What is some of the trends that you're seeing there?
Yeah, so much of this does tie back to the litigation. The main role as a fiduciary isn't to try and avoid litigation, but certainly if you follow all the right steps that we're talking about here, you will avoid litigation. But one of the things that really has changed, I went over all the different settlements, some of the best practices. I mean, this litigation is driving changes in the retirement plan industry for sure. And one of the sort of ancillary changes that we've seen in probably the last 5 years is the role of insurers relative to that fiduciary liability insurance. It was probably 3 or 4 years ago, we first started seeing insurance companies sending what I would say were pretty basic questionnaires to plan sponsors. Usually they only consisted of 5 or 6 questions. Essentially what they were doing was just sort of making sure, hey, plan sponsor, do you have a structure in place to make decisions? And again, like I said, they were pretty short, they were pretty easy. They keep getting longer and longer with more and more questions. We're getting more specific questions relative to the monitoring and oversight of the investments. I'm seeing more questions related to the qualified default investment alternative offered within the plan or the target date funds, asking what the oversight and regular review of those. And since we are talking about fiduciary training today, I've even seen a few that ask, when was the last time your committee participated in fiduciary training and what topics were covered? So, we definitely are seeing the insurers getting more active because they obviously don't want to pay, they're typically, when I talk about $3 to $30 million, that's probably coming out of their pocket to some degree. So they're being a little more assertive in making sure that the plans that they are insuring are doing some of these fiduciary oversight items that we're talking about. So we've talked about sort of just fiduciary responsibility in general, and we're probably going to end a little early here, but I want to sort of close with talking about some of the documentation that you would typically see as your committee gets a little more sophisticated. I think some plans maybe just have one individual who is responsible for making decisions relative to the plan. But as your plan gets larger and there's more assets under management, you are probably going to see formation of either a group of decision makers or even a more formalized investment or retirement plan committee that's really responsible for oversight of your plan. And there are 3 main documents that we really look for as you get more formal in your administration of the plan. So the first is, of course, Candace mentioned at the beginning, every plan is required to have a plan document. So the plan document is absolutely the rules of the road for your specific plan. Now, the plan document essentially governs everything that happens within the plan to the extent that it is not contradictory with ERISA. So again, ERISA is the law that governs retirement plans. To the extent that your plan document is inconsistent with ERISA, ERISA will win. Other than that, though, the plan document will win any other conflict that's within the plan. So again, one of the things as a committee member, you should review, make sure your plan documents are up to date. There are periodic amendments that we get from both the DOL and the Internal Revenue Service. So a minimum annual review of your plan document with whoever the provider is who probably drafted it for you to make sure everything is up to date. And then as you think about your investment committee, one of the things that we recommend, if you are going to have a formalized committee, I mentioned at the beginning that typically the board is probably the named fiduciary, but whoever the named fiduciary is has the authority to delegate oversight and day-to-day administration of the plan to a individual or a group of individuals. To the extent that you do have an investment committee, we do generally recommend that you create a committee charter. And here's some of the items that the charter covers. You know, who are we delegating authority to? Who's the board that has the authority to delegate? The role and responsibilities of the committee, expertise required to participate on the committee. Often it has information on the frequency of meetings. It names a committee chair, individual information like that. And not every committee is governed by a charter, but we do consider it a best practice. And when you think about the charter relative to the next document that I'm going to talk about, which is the investment policy statement, I look at the charter as sort of the guardrails for how the committee or the investment committee is going to function and operate. So it sort of says, hey, here's a committee. These are the things that you're supposed to do. These are the things you're responsible for. The next and final document that we do believe should be in place for every retirement plan is the investment policy statement. So the charter, again, we don't have it in every case, but we do like to use it just to provide additional rules of the road for the committee. The investment policy statement, though, goes into all of the decision-making process that you are going to follow relative to the investments that are offered in the plan. So this includes how you're going to analyze and initially select investments. It covers how you're going to monitor what the parameters are for a fund to still be included in the plan. And perhaps most important, if you have an underperforming fund, it identifies the manner in which you are going to remove or replace that investment. So again, we do believe that every plan should have an investment policy statement. So in closing, I'd like to just say that we do have a very robust fiduciary education program. This is sort of the highest level. Every item that we discussed today, we do have information that has a deeper dive on it. So if you are interested in any of these topics or feel that you need a little more of a deep dive, that I would encourage you to reach out to your relationship manager or your relationship manager consultant, or reach out to me directly. We do have a question that came in. Okay, we do have a question about whether a plan should be using a 321 or a 338 advisor. I think that's a very good question, and I'll explain the difference of that. But you have another good point that I should point out to everyone. You close it with, we also happen to be a church plan, but generally attempt to follow ERISA as best practice. That was included earlier in the presentation. Candace was talking about ERISA and how it governs retirement plans. ERISA does not apply to governmental and church plans, but most of those plans that aren't subject to ERISA tend, even though they don't have to follow those rules, they tend to look at those rules as sort of best practices and follow them as closely as possible. They probably don't do some of the reporting requirements, but that's probably fine. So the question about using a 321 or a 338 advisor, and first I'll just sort of explain the difference. When Multnomah Group serves as a 321 advisor, we are providing information to the committee or to the plan sponsor, and then that plan sponsor is ultimately responsible for the decision. So while we may be a co-fiduciary with you, ultimately the committee is making that final decision. So just as an example, if we have a fund change recommendation, in a 321 environment, we will come present the reasons that we are recommending the change. The expectation is that the committee would review that material, likely discuss the material, and then honestly may or may not decide to make that change. And ultimately that's the committee's decision. In a 338 environment, you actually are turning over the responsibility for the investment decisions to Multnomah Group. And so if we had a fund change recommendation, we would certainly notify you that, hey, ABC fund is going to be replaced with XYZ fund. This is the timing for it. But Multnomah Group could actually initiate the trade. I do think in a 338 environment, you probably give up a little bit of control. So that's definitely something to keep in mind. But ultimately, if you as a committee decide we simply don't want the responsibility for making these decisions, then I would probably recommend a 338 structure over the 321. So we've reached the end of the presentation. Candace, did you have anything else to add?
No, I think you touched on it all. Yeah, just as a reminder, if you want a deeper dive on any of these items, reach out to Greg or your consultant. And I think that's it.
All right, and I'll close with just a plug for the next time you'll probably be hearing from me and the Technical Services Committee will be in October. We are currently working on our annual regulatory update, and we'll be presenting that at the October webinar. So again, thank you all for taking time out of your day, and I hope everyone's staying cool. Have a great day.
Thanks.